I'm Ivan Gruhl, Co-Chief Investment Officer with Avantax. Today we'll provide a market update for March. We'll start with a recap of returns for February, and then shift to a discussion on the Federal Reserve, interest rates, inflation, and our outlook for the months ahead. Following a mixed start to the year in January, the month of February saw strong performance across the board in stocks. The S&P 500 rallied 5.3% during the month, while small-cap stocks led the way as the Russell 2000 added more than 5.5% on the month. On the international front, international developed stocks gained 1.8% in total return, while emerging markets added 4.8%. Looking back on the month, we found it encouraging to see market breadth expanding as the markets moved higher beyond the Magnificent Seven stocks. While Nvidia and Facebook were still the top contributors to the strong performance in February, Apple and Google were the top detractors, and the rally in the performance was broad-based. As this chart shows, outside of the more interest rate sensitive areas like real estate and utilities, the 9 remaining S&P 500 sectors have participated in the upside this year, with communications, financials, and healthcare stocks leading the way. Shifting to bonds, interest rates grinded higher over the course of February, translating into negative total returns for most bond investors. For the month, taxable bonds fell by about 1.6% in total return, while municipal bonds proved more resilient, managing to post a modest gain for the month. For the year, taxable bonds are lower by about 1.8% in total return, while municipal bonds have outperformed, lower by about 0.5%. Higher rates across the yield curve since the beginning of the year have pressured bond prices, as bond returns are inversely correlated to interest rates. As interest rates have moved higher, given market expectations for future rate cuts being delayed, total returns for bond investors have been negative so far this year. Heading into the year, the Fed Funds futures market was pricing in 6 25 basis point rate cuts over the course of 2024, with the first taking place in March. Meanwhile, Fed officials were expecting just 3 rate cuts in 2024, so something had to give. And so far, the Fed has stood its ground and forced the market to readjust its expectations for interest rates. Accordingly, interest rates have been on the move higher so far this year, as the futures markets now expect just 3 to 4 rate cuts for the remainder of the year, with the first not taking place until June or July. This chart shows the implied probability of different Fed fund ranges by the end of the year. As you can see, the markets are expecting short-term interest rates to fall from the current range of 5.25 to 5.5 to around the 4.5% range. With the market expectations now more closely aligned with the central bank, we should see interest rates begin to stabilize and provide a smoother ride for bond investors going forward. For the Federal Reserve, the most significant risk to the soft landing scenario for the economy would be a second round of inflation. We've seen inflation fall drastically over the past year or so, but the final leg has proved challenging. Within the last few weeks, we've gotten both the Consumer Price Index as well as the PCE Index, which is the Federal Reserve's preferred measure of inflation. In both cases, month-over-month inflation was slightly higher than expected, while year-over-year numbers remained on track. Neither the markets or the Fed expect inflation to fall in a linear manner without a few hiccups. And in our view, the broader disinflationary trend for the U.S. remains firmly intact. We continue to remain optimistic on the long-term outlook for both stocks and bonds. Following more than a decade of exceptionally strong performance in the U.S. market, stock valuations sit at the higher end of the range. And as expected, nothing appears exceptionally cheap right now. As this chart indicates, small cap value is the only segment of the U.S. market that is currently trading below its 20-year average from a price-earnings standpoint. Moving forward, we think there's good reason that stocks can continue to move higher. This next chart shows subsequent returns at various valuation levels for the S&P 500 over time. As you can see, there's no reason to expect elevated valuations will lead to negative performance in stocks, but evidence suggests that we could expect forward returns to be lower than average. With that said, earnings growth remains strong, and over the next 12 months, S&P 500 companies are expected to grow earnings by nearly 10%, which supports our outlook for a well-balanced portfolio. So that's what we have for this month. Thank you very much for watching and have a great day.